Joining me now virtually as we discuss this and bring more insight into the latest development we have in the currency market as well as the nation's external reserves. I have Senior Manager at Deloitte, Damilola Akinbami. Thank you very much for joining us on the show this afternoon, ma'am.
For having me. Good afternoon.
Now let's start with our conversation really now with the first 7 months of this year, the performance we've seen in terms of the external reserves growth trajectory and also some decline movement. How would you rate the current economic buffer here in the country, in Nigeria, doing a comparative analysis of what has played out so far really? We have to take a look at debt servicing and also petrol subsidy continuing to rid the country of so much of gain.
Of the external reserves so far this year has been very volatile. We've had periods of accretion and periods of depletion. And if you look at the year-to-date analysis, the depletion in the external reserves is about, let's say, 3.2%, which is roughly about $1.3 billion from $40.52 billion at the end of 2021 up till what it is right now at the end of July, which is about $39.22 billion. And basically, these are just the gross external reserves figures that we are talking about, with an import cover about 8.9 months. So what that means is that the level of external reserves is just sufficient enough to cover an import bill for roughly 9 months. And like I said, this is the gross figures. If you look at the net external reserves figure, that is when you take out the limited, the contingent liabilities rather, so for instance, the swap deals and what have you, the figures that we're going to see would be actually worse and lower than the $39 billion that we have right now, which paints a very disconcerting picture because our net external reserves are at least lower than $30 billion. And why are we having this depletion in external reserves? One, there's the growing demand backlog. We're all aware of the unrepatriated funds of the airlines and also of international companies. And this is occurring as a result of dwindling foreign exchange receipts. And that is because of one, lower oil earnings, and that's because of the oil theft that we're experiencing, which is limiting the price gains. Also, we know what is happening in the global markets with the interest rates increasing globally. So that is driving that reversal of capital funds away from emerging markets like Nigeria. So we have a situation where demand is growing, demand is increasing. However, what is coming in, the Forex receipts are actually declining. And as a result, the impact on the external reserves would be a downward movement.
Some interventions we've seen from the Central Bank of Nigeria, taking a look at the RT200 program and then the Naira for Dollar initiative just to have much more diaspora remittances. However, another question I'd like to ask is how problematic would you describe the situation where we have oil remaining our major foreign exchange earner? Because the current volatility in the oil market due to the Russia-Ukraine crisis, our missed OPEC quota and more puts some more pressure on the uncertainty levels we would have to deal with, wouldn't you say?
So there are various sources of Forex inflow into a country's external reserves level. So one, you have export earnings, so whether it's from oil or non-oil commodities like cocoa, cashew, sesame seeds in the case of Nigeria. You also have a situation wherein, you have foreign direct investments, foreign portfolio investments. But bear in mind that these are a function of perception. And as the saying goes, perception is everything, especially for foreign portfolio inflows, FPIs. That's what we call hot money. So they are triggered by uncertainty. And we call them hot money because as quickly as they're coming into the market, at the sense or sign of the slightest hint of uncertainty, they also leave the market quickly. So definitely, if you're experiencing a decline in your FDI and your FPI, that would also affect the level of your external reserves. Another source of Forex is the diaspora remittances. In Nigeria, we've seen a relatively marginal increase in diaspora remittances. One, because of the CBN's Naira for Dollar incentive, which definitely has had some positive impact. Also because the dollar is strengthening as a result of higher interest rates. So Nigerians in diaspora obviously will be able to send more money because of the value of the dollar that has strengthened. But as you rightly said, for Nigeria, oil still accounts for about 80% of our Forex receipts. So as long as we are still dependent on oil and the environment, the country is exposed to oil market shocks, what's happening in the global oil market, what's happening in Nigeria, we're aware of the fact that because of the oil theft and pipeline vandalism, we haven't been able to enjoy the benefits of the price of the oil price increase. So as long as we still, oil continues to account for a significant amount of our Forex receipts, we're still going to see that impact play out on our external reserves.
Also now has to bring to the fore, really, now it's cliche to have to say we need to diversify an already diversified economy, but how then now do we begin to expand the foreign exchange earner base like you've made mention of? We have to look at some of our cash crops and also other minerals where we make money from, and then the domestic revenue generation strategy base beyond the current volume that we have. How do we begin to intrinsically expand this base beyond the old narrative, and especially taking into consideration that we have the Buhari administration also wrapping up? This is an active election year. Next year too, there's a whole lot of sensitivities and heightened emotions that will come into play just because of the election. So to what extent do you think we can expand our base and have much more policy direction that is clearer in terms of boosting the non-oil sector?
One is, increased focus on the non-oil sector, and we know that the government is already doing that in terms of driving more revenue, or accruing or generating more revenue from the non-oil, and also even boosting the Forex receipts. And especially in a situation or at a time where the African Continental Free Trade Agreement is in place. So the opportunities are enormous. So for instance, in Nigeria now, our number one agricultural commodity export is cocoa. But however, we're like the fourth or fifth largest producer of cocoa. Ghana and Ivory Coast are the leading players. So do we have the competitive and comparative advantage to be able to unlock the benefits in these vast commodity resources that we have at our disposal? Look at yam also. Nigeria is the largest producer of yam globally, but Ghana was the largest exporter of yam as at 2021. So that means that despite the fact that we're producing, or we're the largest producer, we've been unable to generate that into revenue. So what we need to look into that, because that is one avenue to actually broaden the Forex base and reduce our dependence on oil. Another one also is the non-oil, taxes, basically. That's another avenue for the government to generate revenue. And we know that at least, there's been increased an improved collection from the government. The government has become more efficient in its collection of taxes, which reflected even in the corporate income tax, which increased by about 35% in the first quarter of 2022. But bear in mind, there's the tax rate and then there's the tax base. And in Nigeria has the lowest VAT rate in Africa and one of the lowest tax revenue to GDP in Africa. So it's one thing to even increase your VAT rate, which we did a couple of years back, from about 5% to 7.5%. Another thing is also to widen the net base, the tax base, because most, like for instance, the corporate income tax that I mentioned, that's the formal economy. But Nigeria has a very large informal economy that are not fully captured in this tax base. So you need to get these people on board, and also building public trust, public perception about and confidence in the government. The people want to see what their taxes are being used for, what the proceeds are being utilized for. So for instance, are we seeing better roads? Are the roads well managed and maintained? Are there social amenities? So if we can clearly see what these tax proceeds are being used for, definitely the people will be more incentivized to pay their taxes. So I believe that, with the government's efforts in increasing its tax revenue to GDP, that to an extent would also help to reduce our dependence on oil, even for the fiscal part of the government's position.
Talking about government's position as well, we've had to deal with this issue of policy somersault. Now, at a time where we're having the next day election building much more momentum, what's your prediction, especially towards the line of policy direction and also continuity of working models? And where we have policy somersault, we have to have a much more stable economic base and correct these narratives. What's your prediction here for Nigeria?
So typically, in an election year, what you tend to see is a slowdown in the pace of implementation of economic policy. That's typically the norm. So, and especially when, public officials that should be in office, and maybe they're running for office. So most of them they're going to be on the campaign trail. So what you tend to see is that both economics and policy, they take the back burner because the focus is now on politics. And as we move closer to the election period. At least in Nigeria, we have just roughly 6-7 months to the elections, which will occur next year, February. We are going to start to see that slowdown in the pace of implementation. Monetary policy, a lot of monetary policy authorities, what they tend to do, they tend to be apolitical, so they appear neutral and adopt a neutral stance, so they are not perceived to be in support of a particular party or the government, the current government administration. Also, fiscal policy, I mean, we expect to see that the budget for 2023 will be presented to the National Assembly, I mean, maybe sometime in October, in November. But any major or key reform that would be implemented, if at all that would be done, we're going to see that occur between this month of August, September. But the closer we get to the elections, we start to see a slowdown in the pace of implementation of economic policy.
Of continuity, especially with the new government that will come into, that will resume office come next year.
Yes. So again, we don't know what the outcome of the election is going to be. So it's either going to be a status quo, a continuation of the current party, and handing over to a new administration on a different party. So depending on the outcome of the elections, that definitely will play a part and a role on the direction of policy.
Let's also now look at conversations around the the free fall of the naira against the greenback, especially within the parallel market and other global currencies as well. Where lies the fate of the naira now in the coming months as we wait on improved output and overall economic recovery? Because really, at the end of the day, these sectors that need to be stimulated still need the naira to stay afloat.
I think what we should understand is what is driving this free fall in the currency. And it's just basically panic buying. Yet the other fundamental and underlying factors that are driving the sharp depreciation of the naira against the dollar. But as long as there's fear and uncertainty, that would always drive speculative activities. And that's what we're seeing at play. But bear in mind also, I mean, with the naira, let's say, trading in the autonomous market at maybe let's say roughly 700 naira to a dollar, if customer A buys $1,000, for instance, that's 700,000 naira being mopped out of the system. So that tightness in liquidity obviously would limit customer A from coming back to the market. So that's going to sort of like provide some sort of threshold to this free fall, or some sort of resistance to this free fall. So as long as, I mean, liquidity is tight and money is being mopped up from the system, which to an extent would help to create some sort of threshold. And we might not see the naira fall further than that. But again, that is also subject to various factors, various underlying factors. And as long as those exchange rate dynamics are yet to be addressed, as long as we still have dwindling Forex receipts, because the CBN's ability is subject to how much buffers it has. And if we continue to see a decline in the external reserves level, obviously CBN's ability to support the currency will be constrained. So again, I mean, naira liquidity at 700 naira to a dollar or whatever it is, that is mopping up liquidity. And if naira liquidity is tightened, that to an extent would address the demand pressure.
And wrapping up our conversation, just before I let you go now, let's look at the fate of the global economy. We have a looming recession, and everyone is in the space of preparing for a storm is coming, literally, for the fact that we all have to keep that notion at the back of our minds, just because we don't know what is going to be the next global disruption that would have. But in terms of how this would also affect the external reserve base, to what extent do you think this lingering caution or warning of red flag that the Nigerian buffer should never have to get to that 30 billion threshold? How much of a noise do you think that should be in our heads, and also preparing ahead of the next storm that will come or the next disruption?
I think, I mean, the noise, I mean, the alarm bells are ringing already. I mean, everyone is fully aware of that. Everyone knows what is happening globally. And right now, the global economies, the stance that they have adopted, especially the monetary policy authorities, is that of one of a tightening stance. And that's why we're seeing interest rates increase. I mean, so for instance, in the US, they've recorded 2 consecutive quarters of negative growth. So technically speaking and theoretically speaking, that's a recession, but they're yet to call it that. So let's see what the Q3 numbers would be. So, but right now, they are focused on addressing price inflation, which a lot of economies are also focusing on. So as long as these global economies continue to increase interest rates, they adopt a hawkish and contractionary monetary policy stance, that definitely would have an impact on Nigeria. One, in a sense that obviously, I mean, you start to see investors shift towards less risky environments and pull their funds out also, if you look at the unique features of Nigerian economy, what is happening here, also the uncertainty that is occurring as a result of policy uncertainty, the elections that are coming up, definitely that will put investors at bay and could limit the amount of inflows that we would see into the economy and into the external reserves. Diaspora remittances that I mentioned is also a function of the recovery globally, because if there's a recession or a slowdown in these countries, that would affect the level and amount of funds that could be remitted back home in the form of remittances. So, I mean, for Nigeria, what we need to do is also focus on what is happening in the country. We also have our own inflation issues that we're battling with. We have insecurity that we're battling with. So there are a lot of issues that we're battling with. There's the elections that are coming up. And then there's also the issue of the forced subsidy and debt. And bear in mind that also our debt service burden is tied to what is happening in the global economy, because higher interest rates obviously mean that our debt repayment burden would heighten. And remember what the Minister of Finance said, that our debt repayment exceeded what we earned as revenue. That is also concerning. So that's why he said, I mean, the alarm bells are ringing, and I believe everyone can hear it. So we need to take action immediately.
Thank you so much for your time on the show today. It's been a pleasure speaking with you. Damilola Akinbami, she's a senior manager with Deloitte. And then we keep our fingers crossed to see how government is going to react to all of these intricacies. But really, at this point in time, the alarm bells are ringing. Thank you once again.